You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back. It is Thursday. It is 1:30 p.m. Central. It is 2:30 p.m. Eastern. Do you know what's going on in the world of futures options? Well, let's find out together, shall we? It is time once again for TWIFO, This Week in Futures Options. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which so many of you are binging these days. Reminder at the top of the show, if you're not subscribed to the full network, you are missing out on many other programs, including very much the sister program to this one, the Futures Rundown, where we talk all about the underlyings for these options. So make sure you're checking that out wherever you get your favorite podcasts. And of course, if you're ready to go above and beyond, you want to join us for Options Oddities after Volatility Views tomorrow. You want to get awesome pro Q&As. We went deep into silver on the pro Q&A this week and a lot of other fun giveaways, live streams, all that fun. theoptionsinsider.com/pro is the place to go. As we see who's joining us on the old CME Group hot seat this week, I am pleased to welcome back our old pal, Mr. Erik Norland, the senior economist over there at CME Group. Erik, welcome back to TWIFO, sir. It has been too long.
Yes, thank you for having me. It's great to be back.
I'm excited. We have a lot to get to, Erik. So without further ado, let's dive right on into the Movers and Shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers report.
All right, everyone, welcome to the Movers and Shakers report, the portion of the show where we break down everything lighting it up to the light side, aka the green screens, and to the dark side over there at CME Group this week. If you want to see this report for yourselves, make sure you're following us at Options. We always tweet it out right around showtime over there. And if you check it out for yourselves right now, you'd see we are mostly biased towards the red. Maybe not surprising given some of the market action we've seen over the last few sessions. I would say right now we are hanging out roughly 70-30, maybe 80-20 red over green out there. That said, the largest percentage mover is to the upside this week. But Erik, you know what? You are our guest, so I will let you choose where we should begin our sojourn this week. Should we start with the light side and keep things positive, or should we go to the red and to the dark side, sir?
Well, I think, given a rally in precious metals, given a rally in equities, there's a lot of positivity out there. So I think we should start on the positive side.
All right, to the positive, to the dark side we go. To the light side we go. Let's kick it off in dairy, listeners. Class 3 milk up 1.48%. Again, that shows you how light the light side is this week. Only up about 1.5% is enough to break into the top 5 this week. So not a lot of light side to be found out there except for our number 1. You'll see in a second. Can you guess what is the number 1 light side and indeed percentage mover on the week, listeners? We shall see. Number 4 going out to the Ags. It's good old Kansas City wheat up nearly 2%, 1.85%. Chicago wheat coming in right above it, up about 2.2%. So wheat getting a slight lift out there this week. Keeping it in the Ags for number 2, it is the oats up 4.51%. That was number 2 in the other direction last week, off about 7 2/3%. And then the big dog this week, did you guess it, listeners? It's our old pal Nat Gas, up nearly 10.25% this week. It was number 1 in the same direction last week, up 17.33%. So just an absolutely wild time out here in Nat Gas. Maybe we'll get to that on the show in a little bit. But before we get there, let's go to the dark side and let's kick it off. Number 5, listeners, we're going out to Brent. We're getting international on the crude front. Brent off 2 2/3%. Number 4, a complex and a product I have a feeling Erik might have something to say about. This is Bitcoin coming under assault a little bit of late. A lot of headlines talking about how Bitcoin dipped below 100K for the first time in a while. Bitcoin coming into the show off a little over 4% since our last show. Number 3, it is the tech sector of the S&P, off 4.08%. It was number 3 in the other direction last week, up about 4.5%. So giving up pretty much everything it gained last week. Number 2, this will come as welcome news to anyone who's tried to buy a meat product at the supermarket lately. Live cattle off a little over 7%. It's been a wild run in the livestock of late, giving some of that back this week. And then number 1, also welcome news to all you out there shopping for maybe a little bit of steak or ground beef out there. Feeder cattle off about 7.33% this week. It was number 3 in the same direction last week, off about 4.5%. So maybe some of that livestock madness coming back to earth. Run down really quickly through the CVOL for this week as well. Then we'll get out into all the fun research that Erik has cooking for us. He always comes armed with a lot of great stuff. Really quickly, you can run these reports for yourselves, listeners. Just type CME and CVOL, CVOL, into whatever browser you're running out there. Then if you want to line up with the show, you want to go to the 1-week range for the high-low range and go to the aggregates tab. There's a lot more CVOLs than we have time to get to on the show. We just run through the aggregates here. And if you're looking at the list here, it's kind of a mixed bag this week, listeners. Some of the CVOL pinning the needle to the upside, others falling out of bed this week, a couple hanging out in between. So we're all over the place. We'll kick things off in the Ag CVOL this week, coming in 21.5, up 1.3 points just today. That is the high print for the week, the low 18.6. So the Ag CVOL gaining nearly 3 points on the week. That is quite a move for the ag products. Below it, we have the Treasury price vol, listeners. Again, post-Fed, we've seen Treasuries come back down to earth a little bit from a vol perspective. At about 4 1/3 today, kind of unched today. The low was actually a little bit shy of 4 1/4 yesterday. The high right around this level today. So Treasury's kind of hanging out at a very anemic vol level, as you would expect. Below it, speaking of anemic vol, we have FX coming in 6.58, giving off about 0.15 today. That is pretty close to the low print for the week. The high was 6 3/4 out there. So again, starting to get into these low ranges for FX and Treasuries on the vol front. And let's keep going down to the commodities CVOL, listeners, 33 3/4, off about a point today. And that is the low print for the week, the high 34.85. So commodity vol coming back to earth a little bit. Metals vol also following suit, which may surprise some of you out there, given what we're seeing in the metals landscape. Metals have been wild for a while. Maybe some of that vol finally coming back to reality at about a 21 right now, off 1.1 points just today. The interesting thing about our CVOL report, it also shows you the trend for the week, and every day this week it has been red on the vol front. So they have come for vol every day this week. That is the low print for the week, the high 25.4. So wild, almost 4.5 points worth of range in metals CVOL just this week. Absolutely wild. And then bringing up the rear of our list today, it is the energy CVOL, 53.5, off a little over 2, about 2.1 points. Just today, the low print was actually 52.20. So we're hanging out close to the middle of our weekly range right now. The high 55.55. So again, check out those reports for yourselves if you want to know more. But since we're talking such a wild action in metals, vol, and of course metals have been on such a tear lately, I think we have to kick things off there first.
Werewolves Bulls beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, everybody, welcome to the shiny stuff, the wild world of metals. You know where to go to run these reports for yourselves. Just go to cmegroup.com/TWIFO, TWIFO, /TWIO, should also get you there. And then, of course, we're going to go in the asset class all the way down to the bottom of the list to metals. And then from there, we'll see where we hang out, actually, because Erik has a lot of fun research. Erik, we've been talking a lot of shiny stuff on the show of late for obvious reasons. Gold and silver have been on just historic runs, but there's been a few other interesting metals that have been lighting up our tape. A lot of them start with P that don't get a lot of love here on the show, including one of the ones you just talked about in a very recent research paper, palladium. Why don't you catch our listeners up on what's caught your eye in terms of palladium and the impact of EV demand, or perhaps lack thereof, Erik?
Yeah, so I mean, we actually have kind of twin papers out. A month ago, we published one on platinum, and a couple days ago, one on palladium. And both of these metals became really, really inexpensive with respect to gold and silver. So their kind of trading ratios and price with respect to gold and silver got to some of the lowest levels that we've ever seen. So platinum, relative to the price of gold and silver, actually peaked out 17 years ago. And platinum, like palladium, its main use is in the automotive industry for catalytic converters. And so before people started moving towards hybrids and towards EVs, they first started moving away from diesel engines, going back a long time ago. And that kind of accelerated when there was a big diesel engine scandal about 13 or 14 years ago. And then EV sales have surged worldwide in the past few years. In the US, they're up to around 11.5%, but in China, they're up to around 48%. So this really depressed the price of platinum and palladium. Meanwhile, gold and silver prices started soaring for other reasons, basically because inflation's above target just about in every country you can name. Central banks are cutting interest rates despite the fact that inflation is above target. And governments around the world are running gigantic budget deficits and have no plan to do anything about it. And so, gold and silver started rallying so much, with gold hitting a record high of 4,300, silver breaking its old record high above $50 an ounce. And I think people started looking at platinum and palladium, were like, wow, these metals are really, really cheap by comparison. And between early April and mid-October, they had a 90% rally, 90% in 6 months. It's enormous.
Yeah, we have been keeping an eye on all the metals, including the two Ps, platinum and palladium. They have been on wild runs. As you were talking, I was just pulling up to see where we're hanging out right now. And we're hanging out pretty much right around exactly at the start of the show, right around the 1400 level in palladium. So giving some of that upside back since our last show, about 3.75% listeners out there. Obviously, they can't have the upside runs forever out there. We don't talk palladium as much on the show just because it isn't as much of an option story. Sub 1,000 contracts on the tape out here this week. If you are intrigued, listeners, it is about the 1,300 puts that are leading the dance out here this week. So more downside, going up about 100 times that are lighting up our tapes out here. But Erik, I would be remiss if I did not ask you about the big dogs in the metals complex, aka gold, and to a lesser degree silver. It seems like everyone coming on the show, even people who don't normally talk about metals or who are even interested in metals, have suddenly become obsessed with metals for obvious reasons. We don't see many years where this benchmark asset for global economies is up 50% year to date. It's an absolutely wild move. So I'd be remiss if I didn't at least ask you your thoughts about this absolutely wild run we've seen in gold of late, and your thoughts on whether it shall continue, sir.
Well, it's a difficult question as to whether it shall continue, but I can tell you the underlying reason for it is very simple. In the US, we're running a 6% of GDP budget deficit, which is a really big deficit to be running at any time in a cycle, but particularly when you're close to full employment. When you have 4.3% unemployment, you might expect to have a much smaller deficit. And the US is not alone. We have a huge budget deficit here in the United Kingdom, huge budget deficit in France. China's budget deficit's 9% of GDP. Japan, of course, is the king of public debt. Double the size of the debt of the United States. The U.S. debt level comes around 100% for the public sector. Japan's is 200%. Brazil's running a gigantic budget deficit, 8.5% of GDP. And none of these countries really seem to have a coherent plan to either raise taxes or cut spending. So the deficits look like they're just going to continue just about everywhere. Secondly, inflation around the world at the core level, so excluding food and energy, is running 1% above central bank targets for just about every country in the world you can name. I can only think of 3 exceptions, which are mainland China, Switzerland, and Singapore. Outside of those countries, inflation is above target just about everywhere. Third, despite above target inflation, every central bank in the world except the Bank of Japan and the Brazilian central bank, Banco Central do Brazil, is cutting rates. And so people are looking at this situation or saying, wait a minute, finances are out of control at the public level in almost every major economy. And in addition to that, inflation's above target and the central banks are lowering rates rather than raising rates. And so they want assets that central banks cannot print. Now, with respect to the market, this narrative got priced in, which explains that huge move. And the question that I think a lot of people have is, was the narrative maybe overpriced? And that's always a difficult question. But what I can tell you is for the moment, nothing is changing. Central banks are not reversing course, they're not raising rates. Inflation's not coming down. In fact, in most countries, inflation is starting to accelerate. And for the most part, budget deficits are staying kind of roughly the same. They're not really getting smaller because nobody's taking anything and nobody's doing much in a way that's fiscally contractionary to reduce those budget deficits.
You know, it's interesting to watch, Erik, because for a while there, we were seeing these just astronomical moves in gold, threatening 4,000, breaking through it, new all-time highs seemingly every day. And, you know, gold is seen as one bellwether, one measure of risk and sentiment in the economy. Another is, of course, equity volatility. And we weren't seeing commensurate moves in things like VIX. So it was starting to puzzle a lot of people where gold, new all-time highs literally every day, and volatility couldn't get out of its own way. It seems like they're starting to catch up to each other. Maybe gold was a bit of a leading indicator there, Erik, because now we have gold coming back to earth a little bit, and then equity vol starting to tick up. So maybe we were just ahead of the game in gold, Erik.
Well, you know, it's a really interesting point you make about the contrast between gold, which became quite volatile on the upside, and its options became very expensive for a while, or they've come down a little bit now in terms of implied vol, and in equity index implied volatility, which is trading at very, very low levels. There is a historical precedent for this. And the historical precedent, I mean, I can't really speak to the options market at the time, but I can speak to realized volatility. And so realized volatility followed a similar pattern in those markets in the early 1970s. So in the early 1970s, Richard Nixon appointed his friend and political ally, Arthur Burns, to run the U.S. Federal Reserve. And Arthur Burns, you know, was under pressure from the White House to keep policy easy because Nixon wanted to get reelected in 1972. And so what happened is initially the price of gold shot up from $35 an ounce when the U.S. legalized trading of gold in August 1971. It went from $35 to $180 an ounce in a period of about a year and a half. Meanwhile, the stock market loved the easy money too. And so the stock market kept going higher, you know, and as usual, when the stock market goes higher, its realized volatility was pretty low. Now, later on in the 1970s, especially around 73, 74, inflation started ramping up. So bond yields started soaring. The stock market plunged 47%, but gold continued its trek higher. And so basically everything became really volatile. But, you know, I think we're in a situation around the world where a lot of central banks are easing policy. So that's good for the stock market, but it's also bullish for gold. And this could change at some point in the future, maybe no time soon, but maybe a few years down the line, if inflation starts really ramping up and the central banks have to reverse course and start raising again, it could cause a more generalized high levels of volatility across the market. But again, that could be quite a ways in the future.
Well, since we're talking about the big dog, which is gold, let's dive into it a little bit right now, listeners. As you would expect, most of the paper we're seeing this week, about 48% going up in the DEES contract. That seems to be where all the flow aggregates these days. By the way, coming back to earth a little bit from a volume perspective in gold as well. We were seeing numbers recently from an options volume perspective that were astronomical, over 500,000, 600,000 plus contracts going up in gold, just wild prints. We're back down to a more normal, around 250,000 contracts going up this week. So interesting stuff out there. By the way, we're hanging out as we're coming into this segment a little bit shy of the 4,000 level in gold, 39.99 in that ballpark. So gold kind of unched on the week, at least for right now. We shall see how that stands in a little bit. But again, nearly half of that roughly 250,000 contracts going up in the December contract that has about 18 days to go. So still a little bit of duration out there. If you're wondering what is the vol, like we said, is coming back to earth. In the C vol, it's also coming back to earth in gold. DEES vol at about a 1760, off about 3 2/3 points just this week. Skew wise, we're kind of seeing things come back to earth a little bit as well. The puts discounted, but only ever so slightly, about 2.7%. The calls bid, but not that heavy, about 3.3% bid to the upside. So a modest precious metal skew as we've come to expect out there in December. And, we were talking about this last week on the show, some of these wild prints that are lighting it up out there this week. And that continues this week. I think we'll sail by these 2600s in December that continue to trade every day. There's some wild, call it underlying substitution, faux box, whatever they're doing out there. Someone loves the 2600 strike. They've been trading it every day this week and indeed last week. So let's move past that to a little bit more relevant, shall we say. Number 2 this week are the 4200s in December. So DEES upside, again, kind of par for the course. They've traded about 6,500 times this week. The big day was Tuesday, 3,000 going up, mostly opening then. About a 2,000 on Monday, slightly closing, and sub 1,000 every other day, including today, against an OI of 6,000 that's left open. By the way, if you're wondering what's a DEES 4200 going for right now, about $12.30 is the average price today. And then also a little bit of downside, so it's not all upside out there, downside as well. It's the 3,800 puts coming in at number 2/3 with about 6,100 contracts this week. The big day, actually Tuesday, 2,100 going up on Tuesday. Opening there, 1,500 today against an OI of 8,500, 1,200 each Monday and Wednesday, going back and forth, opening to closing. And if you're wondering on those, 3,800 puts $9.20, listener. So there's a little bit of an overview of gold. Erik, do you want to talk some more about any other metals contracts, or should we keep on rolling to some of the other complexes that have caught your eye, sir?
Yeah, let's keep on rolling.
All right. I see you have another complex that is very much front and center for a lot of folks right now in the crosshairs. So let's head on out to crypto next.
It's time to explore the volatile world of Bitcoin, Ether, and more. It's time to talk about crypto.
All right, listeners, you know where to find the crypto. Go back into that report, pop out of the metals tab, go all the way up in asset class to the second from the top, to cryptocurrencies. And then from there, we're going to go into index. If you listened to the show recently, we had the folks running the new CME Ventures over there on the crypto side on the show just a few weeks ago. So those offerings have grown. It's not just Bitcoin and ETH anymore. There's Solana, there's XRP. There's a lot to sink your teeth into. And I know, Erik, you've been sinking your teeth into these new products in terms of research out there. What is catching your eye in some of the newer additions to the crypto space at CME, Solana and XRP in particular, sir?
Well, over the last 2 years, Solana and XRP have been outperformers with respect to Bitcoin and Ether. And there's a couple differences. First, Bitcoin has an extremely slow blockchain. Bitcoin's blockchain and its busiest day in history handled about 10.5 transactions per second. And on a typical day, it does maybe 3 to 7 transactions per second. And so those transactions have to get matched or validated, as they put it in the crypto industry, by people who can show proof of work, that they're doing some work and they get paid by essentially minting new Bitcoin. And it takes 120 trillion calculations for a computer to create a new Bitcoin. So when you validate a transaction on a network, you get obviously paid in a small fraction of a Bitcoin. But the transaction costs on this blockchain can be highly volatile and expensive. The transaction cost of actually transacting in the Bitcoin blockchain itself can range from anywhere from $75 to maybe $300. And it takes roughly 1 hour of what they call finality time, or what those of us in our industry would refer to as getting a trade confirm, saying that the trade has actually been done. And so I think people are kind of looking beyond Bitcoin now to blockchains that can handle much higher volumes of transactions. And so XRP, or the Ripple network, can handle around 1,500 transactions per second. Sol or Solana can do around 3,000 transactions per second. So that's just much, much faster than what we're seeing out of Bitcoin. And the cost of transacting on those blockchains is a lot lower because they don't require proof of work. They only require, say, proof of history, or they have a different means of matching and validating the transactions. And unlike Bitcoin, Sol and XRP also have real life use cases. Bitcoin is mainly a store of value. It's kind of like a gold-like cryptocurrency, where the other ones actually can be used in the case of Sol and also Ether to develop Web3 apps, as well as decentralized finance applications. And then XRP plays an important role in the sort of piping of the global financial industry, helping to transfer funds from one currency to another. So these currencies are gaining interest. They've generally been outperformers with respect to Bitcoin over the last couple of years. And within Bitcoin, it looks like we're seeing some selling recently from some of the very early participants in the market who maybe mined tens of thousands of coin back in 2009, 2010, 2011, who are now taking profit and perhaps diversifying their portfolios.
Let's dive into a little bit of Bitcoin while we're talking. It's obviously been capturing a lot of headlines lately, Erik, breaking through 100,000 again, obviously a very pivotal psychological level. So let's look really quickly at how the big dog is faring over here at CME this week. About 4,000 contracts on the tape in the big Bitcoin contracts. Obviously, the micro doing a little bit more out there as well. And looks like right now, as we're coming into the start of the show, we're a little bit north of 101,000, still off about 8,500 handles, or a little over 7 2/3%. That's just since Monday. If you go back to the end of our show last week, it's off a little bit less than that. But obviously, we are flirting with this seminal 100K level, listeners. Looks like about half of the paper, a little more than that, 53%, once again going up in December. So crypto trading very much like a precious metal, all about December all the time out here. If you're wondering what is D's vol in the Bitcoin options right now, 46 1/4, up a little over 1 point. If you listen to our crypto rundown, we've been talking about Deribit and IBIT options as well, and they're all about in that same ballpark right now, which historically in terms of Bitcoin volatility is actually not very high. So again, something to bear in mind if you're looking at premium harvesting or premium buying strategies out there. Make sure if you're selling that the juice is worth the squeeze, and maybe it's an interesting opportunity to get a deal on some premium out there if you are so inclined. Skew wise, we are seeing again something interesting. And Erik, I'm not sure how much attention you pay to the skew in these products, but since time immemorial, since we launched our crypto show years ago on the network, and since really CME launched the futures and the options have come along, there's always been a bid to the upside in Bitcoin and most of the other major cryptocurrencies from a skew perspective, because that's where the hodlers like to play. They like to hang out there. They want to buy and hold Bitcoin for the long term, and that is reflected usually in the skew. It seems in the last couple of months, we've started to see some chinks in that armor, and we're seeing that again right now. Looking at the DECE options on CME, the puts are leading the dance right now, about 5% bid. The calls 2% cheap. So maybe we're starting to see the end, at least for right now, of that long-term hodler premium in the skew, sir. What are your thoughts?
Yeah, that's very possible. When you think about Bitcoin's history, one of the funniest articles, at least in retrospect, I've ever read, was an article in the Wall Street Journal that was published back, I think, in 2009 or 2010, when Bitcoin was trading at 87 cents. And the article's title was, "Could Bitcoin one day be worth more than the US dollar?" Well, now we're kind of complaining that it's dropped from like $125,000 to $101,000 per coin. What's interesting about Bitcoin is at the very beginning, its price rocketed. It went from less than $1 to $1 to 10, 100, 1,000, and then to 10,000, and then eventually to 100,000. But as it did that, its price has kind of gradually curled over. It's almost like it's kind of hitting an asymptotic limit. If you look at it from a log perspective, it was going up exponentially at first and then kind of more linearly, and then it stopped growing. Now, there's this website I love called Blockchain Info /charts, where you can get all sorts of data about what happens inside of Bitcoin. And one of those pieces of data or time series is the number of transactions per day. And so the number of transactions per day has often been a leading indicator of where Bitcoin is going long term. And it had an exponential rise before Bitcoin prices had their exponential rise. But because of that slowness of the Bitcoin blockchain, about 8 years ago, this number of transactions per day basically stopped growing. And so, since then, Bitcoin went from a peak of like 20,000 in late 2017, eventually got to 100,000, but now it really seems to be struggling. And so I think that what we're seeing in the crypto space is a sort of diversification beyond Bitcoin. This doesn't mean that Bitcoin won't continue to rally. It doesn't mean it doesn't have a bright future, but it may kind of increase more at like a pace that, say, like gold or silver increase over time, or a pace that's sort of maybe more related to the rate of inflation or something like that, rather than this extraordinary gains that we saw during Bitcoin's first decade of existence.
You brought up gold, maybe Bitcoin acting more like a precious metal for a little bit. It seems like the historic move we've seen in gold and the equally aggressive move we saw in crypto this year kind of rekindled that debate. It seemed like for a while it kind of had been fallen by the wayside, the notion of Bitcoin as this digital gold. People were saying it's more like a high-tech allocation or pick your other poison, but it wasn't really digital gold. Now that we're seeing these aggressive moves this year, it has kind of rekindled that debate, Erik. So I'm curious from your perspective, where do you fall on the Bitcoin as digital gold debate, sir?
Well, it's a good question. So on the one hand, Bitcoin has a lot of similarities with gold just from a sort of fundamental perspective. It has a limited supply. There will only ever be 21 million Bitcoin, of which about 19.5 million exist. And the supply growth is slowed down to around 165,000 coins per year as of the last halving in April of last year. And it will presumably slow down again sometime in around March or February 2028 to maybe around 80,000 new coins per year for the next 4 years after that. So it has very limited supply, like gold. And like gold, it also doesn't have a lot of use other than being a store of value. And in the crypto space, it has the first mover advantage, and it has it's still by far the biggest of the various crypto assets. That said, its day-to-day correlation with gold is near zero. By contrast, its day-to-day correlation with the U.S. equity market tends to be somewhat higher. It's not extremely high, but kind of has been averaging around plus 0.4 for the last few years, ever since about 2020. So the Bitcoin market, as well as the other cryptocurrencies, are more correlated with the NASDAQ 100 and the S&P 500 than they are with gold. But sort of on a fundamental level, it is sort of more gold-like in a way.
Well, you mentioned equities. I think we have to head on there next.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, listeners, head back to that report. Pop out of crypto. You're going to go down 2 more slots to equity indexes. This time, though, we're going to do something a little bit different. We always hang out in the S&P, maybe the RUT, maybe a little bit of NASDAQ. But Erik, I like it when you join us because you always take us a little bit farther afield out here, including right now talking about some international equities. In particular, I know some of your latest research looking a little bit south of the border to Mexican equity markets and the potential opportunities of diversifying there, sir. What did you find?
Yeah, well, we have a new contract on the Mexican equity index, and it's I did some research on how Mexican equities perform relative to U.S. stocks, and if you measure from the year 2000 to now, the performance is actually about the same, but the timing of the performance is very different. Mexico vastly outperformed the U.S. equity market from 2000 to about 2012, and from 2012 onwards, the U.S. market has kind of taken the baton and massively outperformed Mexico. But the correlation between the two markets is not particularly high, in part because Mexico has a very different industry mix than the United States does. There's a lot of consumer staples stocks, industrial stocks. Mexico has a very industrial economy. Something like 72% of the exports from Mexico are manufactured goods. And Mexico also has a big tourist business as well. The Mexican economy is very different than the US, and the stock market correlations are not that high. And so it's a very interesting diversification opportunity for people who want to look beyond the US equity market.
Of course, we are recording this show in the midst of a bit of a, not quite a bloodbath. Looks like we're bouncing off the lows out here, but it has been a wee bit of red on the screen in the U.S. equity markets, Erik, a color that maybe some of our newer listeners are not familiar with. They're used to naught but green on the screen for the better part of the last 5 years out here. So a little bit of tumult, a little bit of shakeup. We talked earlier about how equity vol now seems to finally be catching up to what gold has been telling us for the better part of the last few months, is that, hey, maybe there's trouble afoot. Maybe there's another shoe yet to drop out there in these markets. I'm curious, as you're starting to see some more red percolate out there in the major equity markets here in the U.S., sir, what is catching your eye on this latest round of red, sir?
Well, I mean, I'd say it's so far anyway, a very minor round of red. We've had a gigantic rally since the lows in the early in April in the S&P and the Nasdaq, and even in the Russell 2000, which previously had been a bit of an underperformer, and so we're having what amounts to an extremely minor correction over the last week or so. So far, of course, it could always get bigger, but this equity market, I think, is very interesting because there are essentially two things to think about here. The first one is momentum, which has been massively to the upside. And then secondly, there's valuation, and the valuation levels are looking very, very stretched for the S&P 500 and the NASDAQ in particular. The S&P 500 on a price to sales basis is trading at 3.5 times price to sales. Normally, it would be more like 1.5 times. Its price to book ratio is around 5.6 times. That's also about roughly twice or even more than 2 times the sort of average level historically. So this is a market that's looking very, very expensive. Now, what's interesting, though, is a Russell 2000 is looking really cheap. It's trading at like 1.5 times sales, 2 times book value. So small caps in the U.S. look really, really inexpensive. They've massively underperformed the S&P 500 and the NASDAQ. So I think it's like always a question of how much further does it go? This is a very tech concentrated rally, and a tech concentration I think has a lot to do with optimism over generative AI and other developments in the tech sector. What's interesting to me about the big tech companies is their reported earnings have been rising very, very rapidly. And this is a big contrast with the tech bubble of the 1990s, when very few tech companies had any earnings at all outside of maybe Microsoft. But at the same time, while their earnings are going up very quickly, their free cash flow to equity is falling at a very rapid pace, because essentially what they're doing is they're investing in OpenAI and data centers, and these OpenAI, and they're investing in, I should say, they're investing in data centers and in companies that create chatbots. It could be a whole variety of different companies, and then in turn, those companies are buying from the tech companies themselves. They're essentially growing their earnings by growing accounts receivable, which is maybe not the best sign long term unless their investments pay off, which they might.
Erik, I knew you and I were on the same page here because we just ran a question of the week just last week along those same lines, talking about some old school fundamental metrics of the S&P, in particular the PE ratio, which, long-term average somewhere 15 to 16, somewhere in that ballpark, depending on how you look at it. It blew past 30 back in August and hasn't looked back. North of 31 by some measures right now, obviously coming back to earth a little bit right now. But we asked our audience this question last week. We said these astronomical levels of PE, the last times we saw levels at this high or above were, of course, the great financial crisis and the dot-com bubble. Two not exactly momentous times for the bulls. So we thought we'd ask our audience, are you a little bit concerned about this? And turns out 51.2% said, yes, Erik, this is crazy. They're very concerned about this. 22% said they don't care about PE anymore. They've moved past it, Erik. And 14.6% say they don't care about it because AI changes the game to them. Getting back to what you're saying before, some of the productivity gains we could get out of AI now, maybe that changes their viewpoint. And then 12.2%, Erik, say they're along the market still, but they're a little concerned. They're whistling past the graveyard right now. So if you add those two together, you're close to 2/3 of our audience a wee bit spooked. And of course, we posted this last week before these red sessions we've had of late. So I'd imagine if we posted this again right now, we probably would get even higher response. So there is still an audience out there paying attention, Erik, to the old school fundamentals, even if there are quite a few who are also saying, forget about that stuff. It's a new paradigm. But you also mentioned small caps, and I wanted to kind of bring that up today as well, because that's something we've been noticing on some of our other shows on the network. Volume-wise, movement-wise, small caps have been just delivering out there. Coming into the start of the show right now, small caps right around 24.42, so that puts them off about 2% since the start of the week. If we go back to the end of our show last week, obviously a little bit different number. Putting up decent volume this week as well out there in the RUT options, nearly 40,000 contracts. If you remember, the early days of the show when we were talking a lot about RUT, it would struggle to do 10, 15,000, maybe 20,000 if things were wild. So already closing in on 2x that. So a decently active week yet again out here. And the other thing I like about Russell 2000 options, Erik, is I'm not averse to 0-day, but if you try to look at a big product like the S&P E-mini options, half of the volume is going away in 12 to 24 hours. It's hard to really parse that from an analytical perspective. Whereas in the RUT, it does a lot of volume beyond just the 0-day, which is also fascinating. That is the case right now. We're going out to December yet again, listeners. That is where a decent chunk of the flow is going up again in the RUT this week. We kind of have a bit of a tug of war between the 2,400 puts in December, and then we have the 24 quarter puts going away in a day. Those have done 3,500 contracts. Those are technically number one. But right behind them, we have the D's 2,400 puts. Again, nearly 50 handle out of the money puts as of the start of the show, going up about 2,400 times this week. The big day was actually Wednesday, 1,150 of those. Looks like closing, so maybe someone was long those and got the heck out of Dodge on one of the recent sell-offs, or maybe they were short them. Took advantage of a bit of a rebound yesterday to close out their short puts while they could. Either way, a total of about 2,100 going up out here this week against an OI of 1,100 out here. So again, interesting stuff. If you're not paying attention to small caps, as Erik pointed out, you are missing out on a lot of action out there right now. And also, as Erik pointed out, maybe not quite to the lofty valuation levels that we're seeing in some of these other major asset classes. Well, Erik, we are starting to come up against it, but I did want to save a few minutes at the end for a special question I have for you in our futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to your futures options feedback. This is usually where you take the reins, but I have a special question for you, Erik. Before we get there really quickly, our chat, they got derailed by our talk of lower prices in feeder cattle at the start of the show, Erik. So they're talking about steak. So now they're making me hungry. So I think I might have to go get a steak after the show, Erik, because they're all excited about lower feeder cattle prices. But that said, Erik, I have a special question for you because, when I studied economics back in the day, they taught us that there were a few relationships that were inviolate, they were sacred. One of them that they beat into our heads day after day was the Phillips Curve, that there was this inviolate, sacred relationship between unemployment and inflation. And no sooner did I graduate right into the teeth of the dot-com bubble that I realized, oh, wait, this is nonsense. This doesn't hold at all. And it was kind of like, for me, discovering there is no Santa Claus in the economics world. Because I said, wait a minute, if they were lying about that, what else are they lying about? And then it kind of began my great unraveling with economics through the lens of the Phillips Curve. I've maligned it fairly or unfairly ever since here on this network. It's been a favorite whipping post of mine in the economics world. You might be asking, why am I bringing this up? Well, just the other day, my son is taking an economics course right now in high school, which I think is awesome. And he came home and he said, Dad, have you heard about this thing called the Phillips Curve? And he's asking me he had a whole data set and a whole worksheet about it. And I was stunned. I was like, they're still teaching this thing. In the year 2025, they are still teaching the Phillips Curve. So you know what, Erik, I wanted to give you an opportunity as the senior economist over there at CME. Maybe I'm being too harsh. Maybe I've dismissed it unfairly all these years as being complete and utter nonsense. Where do you fall on this seminal economic indicator, the Phillips Curve? Is it nonsense or is there some value lurking in there?
I think it's mostly nonsense.
See, I knew it. Thank you. I feel better now.
I remember studying it too in the early 1990s. But the thing is, as I remember it, I read N. Gregory Mankiw's macroeconomics textbook, and he pointed out in his textbook that it was pretty much nonsense. And so, as I remember his textbook, and this is I want to remind you, I was reading this about over 30 years ago. He pointed out this whole idea of the Phillips Curve. It's kind of started in the 1950s and 1960s, and at the time, there really was some statistical evidence that, you tended to have lower inflation when you had higher unemployment and higher inflation when unemployment fell to lower levels. But as he pointed out in his book, during the 1970s, we had rising unemployment and we had rising inflation at the same time, which was sort of the hallmark of stagflation. Then during the 1980s, we had falling unemployment and generally falling inflation. That continued until the mid-1990s. And then from 1995 to 2020, and I remember writing a paper on this sometime in the late 2010s, we had what I was calling the Phillips pancake, which is it didn't matter whether unemployment was high or low, inflation was always 2%. And then I don't even know what to think after the year 2020. After the year 2020, it's kind of like we don't really have a tremendous amount of data, but I think basically when the government spent, how much was it? I'd have to do the math, $5.9 trillion on COVID, plus another $1 trillion on infrastructure spending, plus $300 billion more on the CHIPS and Science Act, $7.2 trillion. And the Fed printed $4.9 trillion to buy all of that debt. We wound up with, lo and behold, a lot of inflation. And our inflation rate surged up to 7%. Then it came back down to around 3%, but now it's starting to rise again, and not just in the US, but in almost every country on the planet. It's starting to rise again, and almost every country in the world has above average inflation, and the central banks are still cutting rates. So my fear is that we wind up with more inflation as a result. That may not materialize quickly, but over the next few years, we may see inflation rates starting to creep higher again. And I'm not sure that it's closely related to the unemployment rate.
Erik, I always knew I liked the cut of your jib. What's the old saying? You can always tell a genius because he thinks exactly like you. Oh, there you go. You have confirmed. For years, I have maligned it. I was stunned that he came home. I was like, they're still teaching this. I'm glad to see that you think the same way I do. They're still teaching the Phillips Curve in 2025. We've learned nothing over all these years, Erik. All right, we derailed into a little bit of deep economics talk, Erik, but it was perfect timing. I was just going on about this last night, and I said, you know what, to our producers, I said, bring me an economist. I want the official word on this. And lo and behold, you were scheduled for the very next day, Erik. So serendipity abounds here on the show. So thank you for proving my point. I'm going to go march into that econ teacher's office and give him what for, Erik.
You do that.
Well, I appreciate you.
Tell him I sent you.
I will. I'll say, if you have any rebuttal, you go see Erik Norland over there at CME, and he will set you straight. He says it's the Philip pancake now, so there you go. Take that. But Erik, we went on a wild journey today. I appreciate you humoring me here at the end. Even though I have a feeling we can go deep with economics with you, you wouldn't mind that too often here on the show. We'll have to have you come back. We'll debate some other long-standing economics rules and laws just to have some fun here on the show. But in the meantime, if folks want to keep an eye on all the research, we have a ton coming out, just seems like every other week over there at CME. If folks want to check it all out, where should they go? What should they do?
Well, it's all on our website. It's all free. So you can go to cmegroup.com and you scroll to the bottom and you see all of our research there that produced by me as well as my colleague, Dr. Mark Shore.
There you go. Check it all out. We do miss the days of Blue Putnam. I hope he's enjoying a well-earned retirement over there. We miss him and his appearances here on the show. But you know what? We've got Erik. And he doesn't like the Phillips Curve, so he's earned a place on the show whenever he wants, in my opinion here, listeners. Check him out. You know where to go. CMEgroup.com is the place to go to begin your journey. You can head on over into the research side, of course, with Erik and the team. Of course, you can head on over to the /TWIFO reports. That'll get you all the data for the show as well. A lot of stuff to sink your teeth into over there. CMEgroup.com to begin your journey to the dark side. That's going to do it for us on TWIFO. Now going to do it for us on the network today. Back again after the closing bell to break down all the action in the world of options. By the way, if you like the data we talk about on this show with the TWIFO reports and everything else, I may have twisted Nick's arm to create something cool for equity options traders. So you want to tune into that show. Free data. You can't beat it. Make sure you tune in for that. Yet another reason why you should be subscribed to the full network wherever you get your favorite podcasts. Back again tomorrow, noon Central, 1 p.m. Eastern, to talk all things vol on Volatility Views. Then, of course, we wrap up the week for our pro members over there, theoptionsinsider.com/pro, if you'd like to learn more. And then we're back again next week, all the way through to next Thursday, another episode of This Week in Futures and Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.